All right, let's get into it. Today, we're going to unlock one of the most powerful, and I mean fundamental numbers in all of commercial real estate.
So, let me ask you this. How do the pros size up a multi-million-dollar property in like 60 seconds flat? Seriously, less time than it takes to make a coffee. Sounds impossible, right? Well, they have a secret weapon. And stick with me because by the end of this, you're going to have it too.
The answer is the capitalization rate. You'll hear it called cap rate for short, and this is the go-to metric that investors use to instantly judge a property's potential profit and its risk. You can really think of it as the hero of our story today. Okay, so let's dive right in. First things first, what is this number exactly? Well, you can think of it as the ultimate quick check tool for any serious real estate investor. And here it is, the formula, in all its elegant simplicity. Cap rate equals net operating income, you'll hear that called NOI, divided by the property's current market value. So what does that really give you? It gives you the pure, raw return the property generates all by itself, before you factor in any loans or financing. It's really the truest measure of a building's financial pulse. Okay, so how do we actually calculate that magic number? Let's unpack this formula. You'll see it's actually pretty straightforward. Okay, it's basically a 5-step process. Super simple. Step 1, you figure out the gross rental income. That's all the potential rent you could possibly collect in a year. Step 2, you get realistic and subtract what you might lose to vacancies. Then step 3, you subtract all your operating expenses. Stuff like taxes, insurance, maintenance. What you're left with at step 4 is the big one, your net operating income, or NOI. And for the final step, you just divide that NOI by the property's market value. Boom. That's it. You've got your cap rate. But here's a golden rule, and this is just as important. What do we leave out of that calculation? We are not including mortgage payments. We're not including depreciation or big capital expenditures like a new roof. And that is totally intentional. The whole point is to measure the health of the property itself, completely separate from the investor's personal financing situation. All right, so now we know what it is and we know how to calculate it. But why does this one little number matter so much? Well, this is where we get to shift gears from just simple math to real, powerful investment strategy. Think of the cap rate as your instant strategic snapshot. It gives you a quick and dirty estimate of your expected return, and it helps you gauge the risk. Because, a surprisingly high cap rate could actually be a red flag. But maybe most importantly, it's the great equalizer. It lets you compare a retail center in, say, Phoenix to an apartment building in Austin on a true apples-to-apples basis. And just to give you some real-world context here, the average national cap rate for commercial properties in the U.S. in 2023 was hovering right around this 5.5 to 6.5% range. Now, knowing this benchmark, that's incredibly powerful. It means when you're looking at a new deal, you can instantly tell if it's priced above, below, or right in line with the market average. But here's the thing, that number isn't static. It's not set in stone. Cap rates are dynamic. They're constantly reacting to the world around them, which actually brings us to our next point. And this is where things get really interesting, right? There's this constant push and pull with the broader economy. So for example, when interest rates go up, investors demand higher returns to make a deal worthwhile. That pushes cap rates up, which in turn can actually push property values down. It's like a seesaw. But on the flip side, when the economy is booming, demand for property goes up, prices go up, and that pushes cap rates down. The type of property you're looking at also matters a lot. If you look at these average ranges from 2023, you can see a really clear pattern, right? Multifamily apartments. They're often seen as the safer, more stable bets, so they have lower cap rates. But as you move down this list towards properties that have more variables, more risk, like hotels, well, the expected return, the cap rate goes up. Higher risk, higher potential reward. Okay, so all this theory is great, but let's make it tangible. Let's make it real. In this last section, we're going to put the cap rate to work with an actual real-world example. So our source here gives us this perfect case study from the Griffin team. They were evaluating a retail strip center in Colorado Springs. After running the numbers, they calculated the property's net operating income at $200,000 a year and the seller's asking price, $3 million. So, what's the verdict? You take that $200,000 in NOI, divide it by the $3 million asking price, and what do you get? A cap rate of 6.67%. And just like that, boom. Instantly, the investment team could look at that number, compare it to the market averages we just talked about, and decide if this deal was priced right.
It's really that fast. Now, it's super important to remember, cap rate is just one tool in the toolbox. It's different from another key metric you'll hear about, which is cash-on-cash return. The cap rate, remember, is all about the property's performance, totally independent of the buyer and their loan. Cash-on-cash, on the other hand, is all about your specific deal. It's the return on the actual cash you personally put into the investment. And that brings us to our final and maybe most crucial thought. You see a high cap rate, and it looks great on paper, right? It means a higher potential return. But is it always a green light? Or could it actually be a warning sign, a red flag for higher risk that's hiding just beneath the surface? That right there is the multi-million-dollar question that every single investor has to answer for themselves.